Alright, so IAS 10 is about post balance sheet date events. So let's say a firm's year starts on January 1st, right? It goes to December 31st, and this is when the year ends. This is where the year ends. Then it takes another 2 months before the accountants and the employees can finalize and prepare the financial statements. And this is where, this is when the AGM takes place. AGM is basically an annual general meeting that is conducted by the shareholders to see where the company stands and whether they should invest more or they should change the management. So the events or the transactions that happen between January 1st and December 31st will obviously be included in the balance sheet and in the income statement and other financial statements because those transactions, those events happen during the year. But any events that happen between Feb and March 31st will of course be not counted as events after the balance sheet date. They are events after the balance sheet date, but they won't be counted in the previous year. The reason being that after February 2028, the financial statements are being prepared by the press works and by the print works, and nothing can be changed. Nothing can be changed. There can be no changes can be made to those statements. But this 2-month gap between December 31st and February 28th. What happens when events or significant events, I must add, happen between these two dates? In that case, we have to refer to IAS 10 to see whether we have to include those events in our balance sheet, in our financial statements. So there are two kinds of events: one adjusting events and the other one non-adjusting events. So what are adjusting events? So adjusting events are basically that, let's say at November, somewhere over here, I knew about a debtor, I had heard about a debtor that he might go bankrupt, or he has already gone bankrupt, but I didn't have any confirmation. I only knew that there's chances of a huge possibility that he could go bankrupt, but there was no confirmation. And let's say the bad debt was confirmed somewhere over here in January. So, will I record this in my financial statements of the previous year? Yes, I will, because I already had the knowledge, or I had the evidence that something could happen, and in the future that would materially affect the financial statements. So that's why you will adjust such transactions in the financial statements of the previous year. So the examples of adjusting events. Okay, so first, what are adjusting events? Adjusting events are if at the date of the balance sheet or before, if there is evidence, let me use a different color, if there is evidence of conditions existed that would materially affect the financial statement, then the financial statements should be changed to reflect these conditions. Like I gave the example that if I already had an idea that this guy could go bankrupt, right? So I already had the information, but the bad debt was not yet confirmed. The bad debt was confirmed after my balance sheet date. So I should record it into my balance sheet. I should record it into my financial statements because I already had evidence, or I had the knowledge of that it could happen. So that's one example. So the other example could be the settlement after the balance sheet date of a court case which confirms that a present obligation existed at the date of the balance sheet. So let's say we're being sued by someone, and the lawyer is positive that we'll have to pay the penalty, and we've lost the case already, but we still don't know the verdict, and the verdict comes after December 31st. But we already had an idea that we'll have to pay all the penalties and everything. So in that case, I will include these in my financial statements of the previous year. Other examples could be let's say during the year I was considering buying a non-current asset, and the contract had already been signed, but the asset was delivered after December 31st, and I had to pay for the asset after my balance sheet date. In that case, I will have to include that in my financial statements, because I already knew that I am purchasing an asset. The business already knew that it is going to get the asset, and it will pay for the asset in the future. So in that case, you will record it in the balance sheet of the previous year. Other example is inventories where the net realizable value falls below the cost price. So basically, it changes in the valuation of stock. Assets where valuation shows an impairment is required. Refer back to IAS 36, the video where I talked about IAS 36. So if there is an impairment loss that needs to be adjusted, in that case you will include it. You will do it even though it's after December 31st. It's after your balance sheet date. So trade receivables where a customer has been insolvent, that's the same example that I gave in the beginning. And discovery of fraud or errors which show that the financial statements to be incorrect. So if you find any errors, if you find any fraud that basically overstate or understate your profit or your valuation, in that case you will adjust it in the previous year, in the financial statements of the previous year. So that was adjusting events, where you have to make the changes in the financial statements of the same year. So what are non-adjusting events? Non-adjusting events are the events where you if they are material, they are disclosed by the way of notes to the financial statements. So the rule is you cannot hide any event, right? If it's an adjusting event, you have to adjust it in the financial statements. If it's a non-adjusting event, you have to show it by the way of notes. You have to make notes to the financial statement about it. So let's say non-adjustment events include major purchase of assets, that's very basic, losses of production capacity by fire, floods, or strike action by employees. So let's say your factory catches fire, or there's some short circuit, and you lose 80% of your production capacity. So you know, okay, next year your productivity will fall, your production will fall, which is why your profitability will fall. So you make a note in the balance sheet that the factory got fire and 80% of the production capacity has been lost, and it's going to take such and so time to set up the factory again. So you make notes in the financial statements to the shareholders. Other than that, there might be changes in tax rates you want to talk about in the notes, and entering into significant commitments or contingent liabilities. You talk about how you'll purchase something in the future, or how you're probably getting into a contract with someone else. Other than that, commencing litigation based on events arising after the date of the balance sheet. This is basically court case that was that you were sued on after the end year date, and major share transactions, that if you have issued any bonus shares, or if you have made a rights issue or a bonus issue. If a firm has made a rights issue or a bonus issue, you show that, or you mention that in the notes. You do not adjust it in the financial statements. Alright, so in the end it says that if after the balance sheet date the directors determine that the business intends to liquidate or cease trading, and that there is no alternative to this course of action, then financial statements cannot be prepared on a going concern basis. So going concern basis is basically continuing to prepare financial statements and continuing trading based on the fact that you will continue your business in the future and you will not shut it down. So if the directors are determined, and if the directors have decided that the business will liquidate all its asset and it will cease trading, in that case the financial statements will not be prepared on a going concern basis. They will not be prepared on the idea of continuing trading in the future, or running the business in the future. So that was all for IAS 10 for adjusting and non-adjusting events that happen that occur after the balance sheet date.